Hello, I've received several emails over the weekend about Chapter 21, Problem 4, and completing the meta-globalized industry statement of cash flows. And I posted a PDF in Blackboard, but I thought I'd really quickly create a small video to help you understand how to do this as well. So what we're going to be doing is going through the steps as we did in class, where we said that we are going to start with the investing, this indirect method, where we start with net income, and we are going to be reconciling net income for effects that may not have been a cash transaction or transactions which are part of investing versus part of operating. And we go through the simple process of one, start with net income, two, add back expenses that did not affect cash, such as depreciation, amortization. Then we're going to add and subtract gains and losses that are not part of operating income. They are a result of buying and selling long-term assets. And finally, we will be analyzing the current asset and liability account changes because they will have an effect on how cash actually flowed in and out of our business. Because remember, because of accrual basis accounting and GAAP, we will be recording revenues that we may not have received through accounts receivable, and we record expenses that we have not paid through accounts payable. So that is why we are looking at those current assets and current liabilities and reconciling them to the net income. And again, let's look at those tip sheets and say that we are looking at operating activities affected in the balance sheet by current assets, liabilities. Investing activities are being looked at from long-term assets, and financing through long-term liabilities and stockholders' equity. So let's go to the problem and look at what information the author provided us with. The author provided us with a balance sheet, comparative balance sheet, so we could compare one year to the next and the changes that resulted, and then the income statement and what happened to affect net income over the course of our period of analyzing our cash flows. Excuse me. So let's look at the author's answers as it pertains to the operating section versus doing it ourselves. So the author started with net income, as we said, net income coming off of the income statement. And then the author went to step 2, which was to analyze the non-cash transactions. And the non-cash transactions were the depreciation and amortization. We had depreciation expense as it pertained to building and equipment, and amortization of our patent. And those came off of the income statement as reductions to net income, but they are not cash, are they? Those are simply the allocation of costs as it pertains to our long-term assets, capitalization of that cost to be reflected in our net income as we estimated for that period of time. So because they were reductions, we're going to go ahead and add them back. Step 3 says we are going to look and see if there are gains or losses on the sale of long-term assets, investing assets, and they affected our net income. Gains were additions to revenues, and so thus our income increased, and losses were decreases to our net income. So we've got to, because they came from investing activities, they affect net income, we're going to add and subtract them back. So in the case of the gain on the sale of the land, it was an increase to our net income. We're going to subtract it out. We're going to be including it as part of the investing. And the loss on the sale of equipment was a subtraction to net income. We're going to add it back, and we will be taking it out and reflect it in investing. And then the final step is to go ahead and analyze those current assets and current liabilities. And remember, we said that if a current asset increased, that means that the cash decreased. That means that we did not get cash. We are carrying it on our books. And if a current liability increased, that means cash increased because we are using someone else's cash to pay for some of these expenses that we are incurring. So we are not having cash go out the door. So that follows that pattern. Now the second step is to look at investing activities and the cash inflows and outflows from investing activities. Now this is a little bit more difficult because we've got to analyze the individual accounts. And we said that it's long-term assets. So if we look at meta-globalized and their long-term assets, we see that they have land, building, and equipment. And in fact, land, the account value did change by 50. So we're going to analyze what caused that change. Building did not change. It remained stable at 900. We do not have to analyze that. But equipment did change by, it looks like, about 180. So we're going to have to analyze what created that change. Well, we know that at a minimum, some of the changes that occurred came from the sale of land. So we're going to have to know that some land went out the door and at what cost. And we know that there was a loss on a sale of equipment. So we know that there was some equipment that went out the door. We don't know, though, precisely maybe what those costs were, but we do know that ultimately both of those accounts actually increased. So not only did we have sales, we had to have had purchases as well. And the only way really to look at that is by uh, getting in and setting up a T account and analyzing it. The other thing we want to do is look and see if there was any additional information that we might be able to use in analyzing it. So the additional information from the accounting records say that we had sold a piece of equipment that had a cost to us of $660,000 with 90% depreciated. So we do have a little more information that we can plug in. So let's go ahead to a spreadsheet and start plugging in some of this information that we know and analyzing. So I always look and I just plug in whatever numbers are given to me. The first numbers on land that were given to me, that we had a beginning balance of 600 and we had an ending balance of 650. Okay, do we know anything else about land? Well, if we look down below, we see that we have a lease liability of land, 150, that we did not have at the beginning. That means that we took out a lease to buy some or to obtain some land, and while the lease was a non-cash transaction, we do need to go ahead, here's the journal entry, we do need to put that 150 in land into our T account. Now, if we go ahead and add the 600 and the 150, does that equal 650? No, it does not. It equals 750. 750 minus 650 means that we had a decrease in land of 100. So that decrease in land, that gives us the historical cost of the land that was written off our books. And we do know that land was written off the books because we said we had a gain in land of 75. So was that gain included in the 100 that was written off our books? The answer is no, because we know that the amount written off the books was at the historical cost. It is not reflective of the actual sale price. So if the amount written off was 100 with a gain, what must have been the gain on the sale or the actual cash inflow on the sale of land? 100 plus 75, 175. Let's see if we can have the author verify what we're thinking. I scroll down to investing and I look, sale of land, 175. That 175 came from the 100,000 that we calculated must have been written off our books, plus the gain given to us in the income statement. There is where 175 on the sale of land. Now we've dealt pretty much with the sale of land. Where would we include the fact that we have now a new lease liability from obtaining this land? Well, that would be written in the notes to the cash flows. Non-investing and financing activities acquired land 150. That documents that it is a lease that has been acquired, but yet cash did not go out the door. But it did help us to determine the value of the land that was written off our books. So let's now go to the equipment. Let's do the same thing and plug in some numbers. The equipment beginning balance was 3170. The equipment ending balance was 3350. And is there any information that was given us additionally on equipment? Well, yes, in the additional information, it said that equipment with a cost of $660, 90% depreciated, was sold. Again, we always take assets off the book at the historical cost, so we know we have to plug in the 660. I just dropped the zeros. So let's see if that makes the left equal the right. If we minus out the 3170 minus the 660, is that going to equal our 3350? It does not. 2510. That means there must have been a purchase of land to cause that to balance. So if we go ahead and take the 3350 ending balance minus the 2510, it shows us that we had an $840,000 addition of land that we can go ahead and plug in and make it so that our left will equal our right. Let's see if the author shows that we purchased equipment in our investing that caused cash to go out. And there it is, the purchase of equipment. Purchase is an outflow of cash, 840. We've got it. Now they also say that we have to account for a sale of equipment, 41. Where in the heck are they talking about from that? Well, remember, we had the sale of 660,000, 90% depreciated, and they do refer in the income statement to the fact that equipment, there was a loss on the equipment of 25. So let's think about how did they get that? Well, if we had the original cost, 660, that was our original historical cost, but the author says it was depreciated down to just 10% of its value, which is 90% depreciated. It's got a carrying value on the books of 66,000. Did we get 66,000 when we sold that piece of equipment? We sure didn't, because they recorded a loss of 25,000. If we take the 66,000 minus the loss of 25,000 on our income statement, because we have to factor that in our investing, that means we got on the sale of that piece of equipment, the cash that flowed in was 41,000. Let's look at the author's answers. And there it is. We've got the sale of equipment of 41,000. So we have accounted for that inflow on the equipment here. We've accounted for the purchase of equipment, which we determined by setting up our T account. And so now all of our investing activities have been documented. We have documented all the changes that have occurred according to the balance sheet changes and reflecting the gains and losses that we found on our income statement. The final section that we would be looking at when analyzing our cash flows would be investing. And to go through quickly, the additional information told us that the statement of shareholders' equity reveals reductions of 235,000 and 360 for stock dividends and cash dividends respectively. Stock dividends do not affect the statement of cash flows. We're just simply rewarding our shareholders with additional stock dividends. It does change our equity position. You'll be learning a lot about this in Chapter 13. But the $360,000 for the stock dividends came out of retained earnings, or excuse me, for cash dividends came out of retained earnings, 360,000. That does affect our cash flows. Stock dividends do not affect cash flows. Cash dividends do. They are an outflow for financing activities. If we look at the author's answers, payment of cash dividends, 360, that will affect our cash flows. And so we have now analyzed all sections: current assets, current liabilities, gains and losses, non-cash transactions, changes in the balances of the investing activity, or excuse me, the long-term assets, changes in balances, and then the changes in cash as a result of paying dividends. And that is our reconciliation of the beginning cash balance January 1st, the cash balance of December 31st, and we find that we have now reconciled and have our statement of cash flows finished.